At the A4ID climate change event on Tuesday the 25th of September 2012, Aaron Oxley spoke about microinsurance, the various stakeholders involved in microinsurance, and how they collect data on the weather.
Thanks a lot. So, first of all, Christoph, thanks for the introduction. I think that's a really good overview of the UNFCCC process. I should also say that in addition to being the Executive Director of Results UK, I'm also on the Executive Board of one of those think tanks you mentioned, the Munich Climate Insurance Initiative. So I've been to a couple of the UNFCCC meetings, and I'm kind of familiar with a lot of the arguments that you're putting up there. So hopefully, maybe in the Q&A, some of that can come out. What I'm going to be talking about today in this presentation is not so much that end of the business, but more what does this microinsurance thing actually look like when it hits the ground? And a lot of this comes from a previous role that I had with an organization called Microinsure, where we were building microinsurance companies from the ground up, specifically to actually deliver products to help the poor in the developing world. So this is kind of where the rubber hits the road, and hopefully some of this will start to make sense and you get a feel for how this can work in practice. So what is microinsurance? These are just a couple of different definitions. Microinsurance really broadly is any kind of insurance product that's tailored towards providing insurance to the low-income market. What I'm going to talk about mostly today is around the stuff on the next slide, which is, what I've called climate microinsurance, which is not really a term that anybody else uses, so it doesn't have a strict definition. But really, what's useful talking about here today is around providing insurance products for climate or weather-related events, something like drought or irregular rainfall, high wind, storms, cyclone, flooding, these kind of extreme events that Christoph mentioned. Generally speaking, insurance is not a particularly good mechanism for coping with slow onset events. Usually you buy insurance for an unforeseen event, whereas the science seems to be pretty clear that we're going to get sea level rise. The only question is exactly how much of it we're going to get. Insurance is probably not the right mechanism for thinking about those kinds of slow onset events, which is why here we're going to be talking a lot more about these sort of extreme weather events. So really, when people are talking about this kind of climate microinsurance, they generally talk about either weather or crop or agricultural microinsurance. Those are the kind of labels that they give it. And really, again, thanks to Christoph, some of the things he put up on the screen about the challenges of rolling out traditional insurance products, traditional indemnity-based products in this market are why the field is moving towards parametric or index-based products. So the difference is, if you've got a farm that has an insurance product, a regular insurance product, and you have a storm, the insurance company sends out a surveyor to see how many of your plants were flattened, how much of your fruit was destroyed, and then they assess the claim, and then they write you out a check. Well, that doesn't really work when you've got 120,000 farms that are only about the size of this room, and you've got 3 assessors to drive around an entire country after a cyclone's ripped through. So that's just not going to work. So what you do instead is that you look at an index that says how much rainfall fell, how much wind blew through, was there a gigantic hailstorm that covered a particular area? And so you use these indexes to derive whether there's a payout or not, rather than actually go and visibly inspecting the damage. And then allows you to drive these kinds of products to quite large scale. The really interesting thing about these kinds of products is that because they're not indemnity, they're not based on an actual measured loss, is that you don't just have to sell them to farmers or people that are producing agricultural goods. If you look back at the literature on famines, for example, Amartya Sen discovered quite surprisingly that actually famines, if you look at who goes hungry in a famine, it's not just the farmers that go hungry, it's quite often the day laborers who would make their income from picking or harvesting the crops for the farmers. Without being able to harvest the crops, they have no income, they can't buy food. They're the ones that turn up in the feeding centers, not just the farmers. So actually, if you're a day laborer in some countries, it makes sense for you to be protected against an extreme weather event like a drought, because otherwise you don't have any income. So by having these parametric products, you can actually protect more people than just the farmers by making those available to a larger part of the population. So why microinsurance and why crop microinsurance? I mean, this is really, why we work on this stuff. Over 2.4 billion people are living less than $2 a day. The majority of those people still live in the countryside. And the majority of those people are going to be hit the hardest by climate change in terms of weather variability, in terms of increasing droughts, increasing floods. We've all seen it on the TV. And the variability is one thing that I think most people don't realize. But if you've got you've got if the monsoon looks like it started, and then because of weather variability, it stops early, you've already planted your seeds. Those seeds sprout, and then because there's no rain, because the monsoon hasn't really started, they then die. And you've wasted all of those seeds, and you've got a hungry season coming up when the monsoon starts properly a couple of weeks later. So variability is another one of those things that most people don't necessarily think of when they think of extreme weather events. The other thing is that we've got farm sizes shrinking, but most importantly, agriculture has a really special power in reducing poverty. The World Bank World Development Report from 2008 made that really clear. If we can increase GDP growth in agriculture, that's twice as effective in reducing poverty as GDP growth outside of agriculture. So if we're talking about dealing with the effects of climate change, we're not only protecting some of the most vulnerable people in the world, we're also doing one of the best things we can to increase that country's GDP and ultimately drive development and increase resilience amongst those populations. So this is why this is a really important thing to get right. So let's look at a typical product. Let's look at drought insurance. So you've got a farmer. Someone wants to plant some seeds and wants protection against low rainfall. You need to first of all be able to measure that rainfall. In a lot of parts of the world, that means you need to be within 20 kilometers of a weather station. If you're in a place like Rwanda, that's not good enough because Rwanda is really hilly, and so you've got lots of microclimates. So you have to be much, much closer to a weather station. But if you're talking about a nice flat country, a nice continental, with continental weather patterns, then 20 kilometers is a pretty decent radius. So there's your first problem right there, is you've got to have a lot of weather stations. And those weather stations have to be properly manned. They have to be reporting data back, all that kind of stuff. The other problem with a lot of with these kinds of drought insurances is that quite often you are going to build a model for that crop, which is specific to a certain crop, a certain soil. And so you need to know even sometimes down to the sort of seed variety that's going to be planted. And that can lead to all sorts of problems because then you're talking about only working with a certain subset of farmers, particularly, rather than a whole community. So there, the product development piece and getting that right so that you can have the product applicable to not to just one seed or one crop type, but actually to the whole weather system is really important. And what that looks like in practice, and I'll go to the next slide here, is that you have, for example, you have on the left there, the light blue boxes in the bottom left corner. When the rain starts, there's this kind of a dynamic start date for when the policy would start. And then for each of the 3 growth phases of the crops, you need to get enough rainfall during that period of the growth phase of the crop to make sure that the crop is going to grow and fruit and flower and produce the yield that you need. And if there's ever a fluctuation in the rainfall during each period is such that the crop doesn't get enough water, then we just write the crop off because it will be dead or so severely damaged that it won't be able to produce enough fruit. Now this was a sort of a phase one. This was kind of a first generation model. There are much more sophisticated models now that aren't quite as complex. One of the ones, for example, is a dry day model, which doesn't rely on measuring every single last millimeter of rain that falls throughout every day of a crop's life cycle. It sort of says, well, actually, I don't know if any of you have been to certain parts of Africa, for example, but if you go to Zambia during the rainy season, it's 4 o'clock in the afternoon, it will rain. It usually rains pretty hard. And everybody can see whether it rained or it didn't rain on any given day, because when it rains, it really rains. That's just the way the weather patterns go. So rather than worrying about every single millimeter and then having to be next to a rain gauge or a weather station, you can just look at, did it rain or not? And that's something you can measure from a satellite much more easily than you can in terms of down to the very last millimeter of rain. So you can actually have a product that says, if you have more than 5 dry days during the first 20 days of crop growth, you get a certain payout. If you have more than so many dry days during the first 50, you get a certain payout. So you can build products that way, which is much easier to measure and to implement. Challenges around that. A big challenge to actually doing microinsurance of this kind of stuff for crops or otherwise for those other kinds of products is the availability of data. To price this stuff properly, you need decades of data. 3 decades is kind of the minimum. 4 decades is nice. We've got that kind of data here in the UK. We've got data that goes back over 100 years. We don't have that kind of data in a lot of the parts of the world that are most affected by climate change. The other problem with it is that you have to have that data being made available in a timely fashion. We did some work in the Philippines, They have a lot of weather stations in the Philippines, 7,000 islands there. But they also have a lot of unmanned weather stations, and they also have huge problems in terms of collating that weather information in a timely fashion and then making it available to organizations that can then use that weather data in real time to drive decisions around things like insurance payouts. We're talking sometimes weeks or months to get data that should ideally be available in real time. And then there are also challenges around acceptability to farmers in terms of some of those, again, those challenges that Christoph laid out. I mean, you know, attitudes, cultural barriers in education, absolutely, and that's a big problem. One of the big ones is around basis risk. And for those of you that aren't insurance specialists, what basis risk means is that because this is an indexed product, we might measure at the rain gauge that there was plenty of rain, but the farmer might be 18 kilometers away and in a rain shadow on the wrong side of a hill or something. And that particular farmer got no rain, and all his crops, will actually be all her crops are dead. She's going to be very upset. Her crops are dead. She had an insurance policy, but because it rained at the rain station, she doesn't get a payout. That's what basis risk is. And you get that with any indexed or parametric insurance product. So managing that and minimizing that is a really important part of designing these products. Another thing was around affordability that Christoph mentioned. Affordability is a real big one, but there are ways around that. A couple of big ones are, particularly if you're working with farmers, is making sure that they're tied into a value chain and that they're accessing farm extension services. So if you've got a farmer who's getting access to high quality seeds and already has a market set up for their crop, they can move into developing cash cropping on their farms with a whole pile of access to finance and access to the kind of technical expertise that means they're going to be successful. And all that can actually be done through other microfinancial services such as microcredit. And what you've done by building in a microinsurance is that you've taken out the single biggest risk that those farmers face, which is the bad and variable weather. I think I might jump onto this next slide to talk about the other thing about pricing. This you can't see it so well, but this is the Philippines, and that's a map of Typhoon Frank, which was a pretty big typhoon that went through the Philippines a while ago. The Philippines is the country in the world that experiences the most typhoons of any in the world, or cyclones, depending on how you want to name them. They're the same thing. And this is the typhoon track of Typhoon Frank. The Philippines gets, on average, about 50 typhoons every year. It's quite a lot. Some of them just graze it. Some of them don't cause much damage. Some of them are fairly catastrophic. And one of the pieces of modeling that we did was looking at analyzing the data of where crop losses were occurring across the whole of the Philippines. And so the question of affordability became very, very clear when we looked at the northern part of the island. If you look right at the very sort of top there, just above the top of that track in the middle, that part of the island, it's a pretty rubbish place to be a farmer because your average losses every year are pretty much 50%. So what that means is that 1 year, you're going to lose everything. The next year, you'll be fine. The next year, you'll lose everything. So the idea that farmers that are living in the northern part of the Philippines can afford to buy a commercially funded insurance product just doesn't wash. There's no way. They'd be paying, you know, to get $100 of insurance, they'd be paying $80 in insurance premium. So that just doesn't work. So insurance is a mechanism that could work there, but that's only going to work in the northern Philippines if we've got a hefty government subsidy or other kind of donor subsidy, making that affordable for the farmer to access. And that's just the reality of the amount of damage that's going on there in that particular part of the country. Typically, you're looking at, in areas that aren't quite so heavily damaged regularly, and most of the places where this kind of stuff works, typically the sort of premium in terms of the fair price premium that allows like kind of a market price premium, you're looking at anywhere between 8 and 15%. So to get $100 worth of cover, you need to spend between $8 and $15 on your premium. Farmers generally want to pay somewhere between 3 and 5%. So they want to pay for $100 of cover, they want to pay $3 to $5 of premium. So, you know, there's quite often a disconnect. Like most people, rural farmers in the developing world underestimate risk and are not usually prepared to pay the true price of what insurance coverage actually costs. And that's the same that's something us human beings do all over the place. that's kind of what it looks like on the ground. Here's what it looks like in terms of who the players are. And let's start in the bottom left corner with the front office box. That front office box is really the organization or actor or player that's reaching out and actually talking to people and selling the policies and making the stuff happen on the ground. If you look at some of the microinsurance that's happening in the world right now, that could be a farmers cooperative or a seed cooperative or a national seed or fruit marketing board. That could be an NGO. That could be a faith-based organization, like, for example, the Anglican Church. There could be a microfinance organization. There are a whole pile of different organizations that have existing relationships with people that are living in risky environments and could benefit from some kind of weather or climate-related microinsurance product. This is a trusted intermediary that is already in contact with these folks. The back office, just to the right of that, that's an organization that makes it all happen. They design the products, they work out how they work, they do the pricing, they help collect and process the premium, do all the bookkeeping, track all that stuff, potentially manage the payouts and make sure that the claims are all valid. You know, they're the ones that are doing all of that kind of processing. And then that top box of the central triangle, that's the risk carrier. That's the organization that is usually legally incorporated in a country as an insurance company and is regulated by the insurance regulator, that box on the left, in that given country, because insurance is regulated country by country, just the same all around the world with individual countries' regulators. Quite often, the risk carrier and the back office are the same organization. They're an actual insurance company providing both functions, but not necessarily, because quite often risk carriers are just interested in carrying risk and will let some other organization do a lot of those back office functions. That's particularly important for microinsurance because microinsurance is often a very, very high volume, very, very low margin business. And the reason why existing insurance companies aren't in that market already is that they don't know how to do those kinds of products at those kind of volumes with the kind of margins that are being made available. On the right there, the data provider I've got, that's for example, the organization that's providing the weather information. I put them in there because they're quite important. They're usually the government or National Weather Service, but occasionally they aren't. But they're a real key player because you have to be able to get the data before you can do any of this stuff. An example of when it might not be the government, in Ghana, for example, a gigantic cocoa growing country, the biggest network of weather stations there is actually owned by a very large multinational chocolate company, who I won't name. But you know, they have a really, really extensive network of weather stations there because their business relies on knowing what the cocoa harvest is going to be that year, and to do that, they need to know what the weather is going on with the weather there. So the regulator on the left is the in-country insurance regulator. That's regulating the risk carrier. One of the things that's happening in practice is that because all this stuff is so new, if you go to, say, Malawi and say to a Malawian insurance company, hey, you want to do this new product that, you know, nobody's ever done it before, and we're going to be insuring these farmers that you don't even, know who they are, and they're going to be planting these tiny little crops of, 1 hectare of maize and 1 hectare of peanuts, that risk carrier is going to be like, I don't understand that risk. I don't know how to manage that. I'm not willing to carry the whole Malawian maize harvest on my books. What happens if we go have a drought? I'm going to go out of business. I don't have the capital. So they will almost always want to reinsure a whole pile of that risk up to the international level. And for those of you that, everybody probably knows what a reinsurer is, but just in case you don't, a reinsurer is a company like Swiss Re or Munich Re or one of the big international players that aggregates risk on a global level. So typically when you're starting out in a country, you'll have the local risk carrier, the Malawian or the Zambian insurance company carrying maybe 5 or 10% of the actual risk, and the rest of it they'll reinsure up to the global level. And over time, as they get more comfortable with the product and comfortable with understanding the mathematics and what's happening on the ground and the business processes, because they can make more profit if they take more of the risk, they'll move more of that risk back down from the global level to the local level till everybody gets to a level they're comfortable with. And of course, the reinsurer, if they're based in Switzerland or Germany, is regulated by a different regulator than the one that's happening on the ground. Those are kind of the main actors and the main things that are going on there. You can sort of see already that there are quite a few moving pieces. This is without taking into account the fact that a lot of these products are quite new and that actually you've also got things like specific NGOs, government departments, academic institutions like the Earth Institute in Columbia in the US, who are providing a whole pile of technical analysis and product design and evaluation and all that kind of stuff to help build these new products and test them and make sure they work and do the monitoring and evaluation on how they're all going. So I just want to finish with this slide, which is about impact and what this actually all means in the real world. These are two people who live in northern Malawi. The woman on the left is called Frida, and the guy on the right is called Goodlove. They're both standing in their maize fields. Frida was a woman who was able to access a micro crop insurance. She was able to get access to high yield seeds. She got a loan so that she was able to plant not only those high yield seeds, she was able to fertilize them. And she was able to plant 2 hectares of maize rather than just 1 because she was able to access that loan. She would have never gotten that loan from her rural bank if she hadn't have also been able to have gotten drought insurance. Because if there's a drought, she obviously can't repay because her crops have been destroyed. But because the loan that was given to her was insured by that microinsurance product, there's her maize. It's higher than her head. She's not particularly short. She is shorter than Goodlove, but she's not that short. Goodlove, on the other hand, he planted the seeds that he had left over from last year's harvest. These photos were taken one day after each other. And you sort of see his aren't even up to his waist. So he's using, I mean, the yield per hectare that he's going to get, you know, he wasn't able to properly fertilize the crop. He's not planted as many hectares as her. She's going to be earning in terms of income and in terms of food security way more than he is that year. And that was because that micro crop insurance helped unlock that investment in her farm. And I think ultimately when we're talking about this, when we draw the thread from what's happening at the United Nations climate change negotiations and how microinsurance is now written into the draft negotiating text and it's being looked at as one of the available mechanisms for dealing with loss and damage, I think we need to remember that this can be far more powerful than just dealing with loss and damage. It can actually be an important driver in unlocking rural livelihoods, increasing the money that people can make rurally, driving food security, and a whole pile of other really interesting positive externalities. So I'm going to finish there.